Thank you.
Good morning, Mr. Carroll.
May it please the Court. James Carroll on behalf of Fremont Investment and Loan. The critical legal error of the Superior Court, and as affirmed by the single justice of the Appeals Court, is crystallized in a passage of the Superior Court's decision, in which the Superior Court held, and I quote, "To be sure, the fact that Fremont's loans bearing these four characteristics were not generally recognized to be unfair is not irrelevant." The Court then goes on to say that the Court will take that factor into consideration in crafting the appropriate injunctive remedy.
Of course, you're familiar with the broad definition given to unfairness under our consumer protection statute, are you not?
I am, and indeed my argument...
I mean, something could even be legal and still be unfair.
That's exactly correct.
It is.
And 93A is meant to be flexible. And I think the jurisprudence under 93A confirms that.
Would you call these things predatory loans?
I would not. Massachusetts has a predatory loan statute. These loans are not covered by it. The flexibility that Your Honor rightly points out with respect to 93A is very important to this argument. It is a flexibility long established, but it is not a flexibility without any limit whatsoever. My argument hinges on the proposition that this Court's prior precedents articulating that standard in this context, where there is no statutory violation, has within it an important limitation that makes all the difference.
Would you agree that a fact finder might be able to find that these loans were made to people in a situation where Fremont could reasonably believe they could not repay the loans?
Your Honor, I wouldn't, and here's why.
Keeping in mind we're here on a preliminary injunction standard, not a trial standard?
Yes.
But I'd like to step back, though, from that question. Are you under any obligation to take into account the borrower's ability to repay the loan?
Absolutely, and that's critical to the answer.
Absolutely not.
The borrower...
Absolutely yes or absolutely no?
Absolutely yes, and Fremont
Absolutely
did
yes.
so,
Okay.
and the Court so found at page 8 of the decision. The issue here is how it is that a lender must do so. The standard applicable for...
Wait a minute. You say that you took into account their ability to pay the loan back. That's based on the interest rate at the time they entered into it, not what the interest rate would be once the teaser rate was no longer in existence and once the ARM rate no longer existed.
That's right, Your Honor.
So you didn't factor in 3 years from now the rate's going to be much higher and they won't be able to repay it.
The loans were the Superior Court found that the loans were that they were underwritten at the introductory rate. Now, why is that? Why is that practice consistent with the standards of conduct that should be applicable to 93A? And here's why. This Court's precedents hold that 93A may attach to conduct where that conduct is within at least the penumbra of a common law, statutory, or other established concept of unfairness. The concept that a lender must underwrite loans such as these by looking at the fully indexed rate is indeed a concept of fairness that exists today.
Yeah.
That concept of fairness did not exist when these loans were being underwritten. It came into law, it came into practice in 2007.
But when you say it didn't exist, isn't there a sort of common sense argument that a loan that is calculated using the teaser rate as opposed to the fully indexed rate, which is, at least using this injunction, more than 3 percentage points higher, right?
Sometimes, yes.
Whether you've got a regulation or whatever, it sort of smacks of unfairness because it just seems to have within it some view, some inherent problem about the ability to pay.
These loans, from the perspective that we stand here in October of 2008, unquestionably look to be unwise loans. At the time these loans were made, years before.
Yes?
These loans were remarkably successful vehicles for many years for people who had never been able to get into the status of homeowner to come into that. They're risky loans, to be sure. They're priced accordingly, not priced, however, outside the very exquisitely drawn statutory
Well,
rules as
these
to
are
how the loan must be
subprime
priced.
loans, aren't they?
They are indeed.
Which have caused the big mess that the country's in.
Well, I
And which
think
have led, at least according to the Commonwealth's appendix, to 4 or 5 other companies similar to yours entering consent judgments to get out of these cases. Have they not?
they have. They have. But the
And in
issue under
1997, did not the banking commissioner issue a directive warning about these loans?
in 1997, the banking commissioner and others recognized the risky nature of the loans. What's at issue here is not the
And
fact that the loans
specifically stated that they might be looked at under the Consumer Protection Act as violative of that act. Did he not?
certainly consumer protection principles are always at play with respect to lending, no question about it. The history with respect to how these loans should be underwritten, however, is quite clear. In 2007, regulatory guidance came in for the first time that said lenders must underwrite loans such as these by looking at the fully indexed rate. Prior to that time, as found by the Superior Court, they were not generally recognized as unfair. They had not been, there was no rule against underwriting at the introductory rate by any of the multiple federal or state banking regulators. That today is indeed, that is a concept of unfairness. The Attorney General herself promulgated regulations in 2008 to effect that. But what the liability theory embraced by the Superior Court and affirmed by the single justice does is it takes a 2008 concept of unfairness as to how lenders must do their underwriting and imposes it back on 2004.
Can I ask you a question to which I know you don't know the answer, but maybe you guys, and he doesn't know it either, maybe you can check on this. Does this new bailout bill have any preemption provision in it that might block these kinds of lawsuits? Because these lawsuits could come fast and quick in all 50 states.
Your Honor, I don't know, but I would ascertain to find out.
Okay.
I would
Mr.
ascertain to-
Callow, this really goes to a business question more than an unfairness question, although it might implicate it. The loans were mostly given to, as I understand it, to people of limited or impaired credit,
That's right.
correct? So if you're giving somebody a loan, and it did have a tremendous impact on giving access, I mean, people can have, for example, an impaired credit because they have a medical disaster, and they've settled that, and they're now back and going, but their credit rating is, shot. But if you're looking at people with a limited or impaired credit, and you are not, and you have a low rate to begin with, and it's a variable rate and it increases over time, however one describes those, doesn't it seem sort of counterintuitive to think that a vast number of those people would be able to sustain their loan repayments?
It may in 2008. It didn't in the period in time in which these loans were being made. And the reason is this, Your Honor.
Why
These loans
not?
were
Just
frequently...
hold on 1 second.
These loans were frequently used by people as their introductory way into home ownership, people of impaired credit,
Right.
people who had credit problems. These loans were made at a period of time when they could get in these loans and establish a credit rating to begin with, repair damaged credit, and use the loans in such a way so after 2 or 3 years they could refinance out, and that's indeed what happened much of the time. It's when the real estate market flattened and then declined, when interest rates started to move up, that the loans...
Is there evidence of that in the record?
There's evidence in the record of the manner in which the loans were utilized. There's evidence in the record of the key point that I think is relevant for this
Right.
appeal, the underwriting and the criticism that came from the industry. There was proposed regulation for the first time applicable to these loans in March of 2007, intra-agency federal regulation. The Federal Reserve, the OCC, the FDIC, multiple federal regulators that impact loans said, we're thinking about, we promulgated, put out for notice and comment.
In response, you would say, to a declining real estate market or some external factor?
What's happening is that the environment was changing.
But was it reasonable to expect back then that real estate values would always go up?
I don't know that the expectation had to been that real estate values would always go up, but the underwriting analysis at the time, based upon looking at what you knew the payments would be for the short period of time, were made. And maybe that was a bad business decision. And from 2008, they looked to be unwise loans. But that's a different question, respectfully, than whether a practice is unfair and deceptive. That conduct must be measured against the standards existing at the time. That's what
Well,
PMT stands
it
for.
has to be measured, in my judgment, of the standards that existed at the time, unless there was no reasonable, there could be no reasonable expectation that these could work. If you're telling me that there's evidence in the record that, in fact, these were for people of limited or impaired credit, they were imaginative, take the situation I just gave you, and in fact, there's evidence in the record that in some number, significant, I don't know what the number is, that people, in fact, used it, and then once they were back on track, refinanced and got out of those. It seems to me that's a very different kind of thing than to look at an external force of a declining real estate market or something like that.
Well,
So I need to know whether that was before the Superior Court judge.
the best evidence of that in the record exists if you look at the federal regulatory guidance in the commentary, including when there's a published notice that comes out, it goes out for notice and comment, and what comes back from the industry. And you'll see the explanations there as to why these loans made sense and why, indeed, the industry objected. In 2007, when the federal regulator said, we want you to underwrite at the fully indexed rate, not at the introductory rate. What the industry said essentially is if you impose that rule, you will eliminate classes of people from being able to get the loans.
But that may not be a bad thing.
It may not be a bad thing, and indeed today, that's the established concept of unfairness.
Can I ask you this, going back to Chief Justice Marshall's question about what might be in the record, and I've been reading so much stuff it's sort of all blurred, but at some point there was a reference to there being 15,000 loans, and at the time of this litigation, 3,000 loans, all the others had been closed out in some fashion?
The Commonwealth alleges that Fremont made something in the neighborhood of 15,000 loans during the period of time applicable to the lawsuit, which the Commonwealth defines as 2004 through March of 2007, when Fremont ceased making loans. And I emphasize that because the guidance about using the fully indexed rate comes after Fremont's not making these loans anymore. Similarly, with respect to the reference to 183C, that law comes into effect in November of 2004, when thousands of the loans subject to the injunction have already been made. The numbers currently have dwindled considerably because most of those loans, particularly the ones made in the early part, have been refinanced.
Well, that's the point. I mean, the point is that we've got...
Is that in the record?
I mean, that...
The injunction came on an expedited basis. These were not the arguments that were the focus below. The best place in the record really to look and see what happened historically to the loans is indeed the regulatory guidance and the explanations
Mr.
therefore.
Keller, let me ask you this. I take it that what we're really talking about here is underwriting. We're not talking about disclosure.
Exactly right. And that makes this case remarkably different from this Court's precedents. The Superior Court correctly found no misleading conduct by Fremont. All of these loan terms are fully disclosed. Of course they are. They get fully disclosed on federally required forms. To the extent
I remember that at my last real estate closing.
and importantly, to the extent that there's any fraud here, and the Superior Court noted that the record does include fraud.
But the whole issue is not deceptiveness, but unfairness.
It's entirely unfairness of contractual terms in an industry that is elaborately regulated by multiple
Could you
federal...
clarify one thing for me? You say that once a person got a mortgage, theoretically they could refinance at the end of the ARM period. But that only is so if the rates are going up, isn't it? If rates are going down, they can't refinance.
It's dependent on multiple things. Most importantly, it's depending on what happens with the real estate markets. It's dependent upon what's happening with prevailing interest rates at the time. It's also dependent upon an individual's credit rating and experience, because with a refi, you'll have, again, a new underwriting that has to take place.
Yeah, can I ask you another question? Your time is almost done with regard to this argument, which boils down to, as I understand it, it was legal when we did it, so it's can't be a violation of 93A. In 1997, the banking commissioner advised banks and others that were going to engage in this kind of thing, which you agree are subprime loans, are they not?
Indeed.
Yes. That even if you were in compliance with all consumer protection laws, if the loans were underwritten, which is what you're talking you did, on an unsafe and unsound basis, it would still be considered a violation of 93A. He further advised that in dealing with the kind of folks that were getting these loans, the consumers should have credit counseling before they entered into these loans. You were aware of all those things.
Certainly.
Did they have credit counseling?
Now, there's nothing in the record that says so, but there's no allegation otherwise. May I respond more fully to the question?
Sure.
Yeah.
It is not our position on this appeal that because there's no statute prohibiting the underwriting in the manner in which it was done at the time it was done, that automatically is a complete defense to 93A. My argument is not so narrow, and I think that would be a mistaken argument under the flexible principles that this Court has laid down as to 93A. My argument is different in this respect. The Superior Court, surveying not just the law, looking at what the industry was doing and coming to the conclusion, rightly so, that we as a society did not understand these loans to be unfair at the time they were made. Putting that juxtaposition between that factual finding of the understanding at the time next to this Court's precedents from PMP, which says to have the 93A violation, you have to run afoul of an established concept of unfairness, I think crystallizes it this way. What has happened here is that a very hindsight, retrospective-based concept of unfairness is being employed to loans made earlier in time before there was any practice, any guidance, or anything else.
Well,
that
but
said
the flags were going up in 1997.
The flags that were going up in 1997 realized that these are risky loans being made to people without credit histories.
But when
The
did you stop
1990s
you said you stopped making these loans by that time?
No, we stopped making loans in
2000.
07.
07. Oh, I'm sorry.
In
okay.
07.
Madam Chief Justice, can I ask another question,
Sure.
please? There is this FDIC consent order and cease and desist order, and that's on the basis of that. That was March of 2007. You did stop making loans, correct?
Correct.
All right. And I know that it's clear that you've made no admissions in here as to having done any of the things that are in the order.
Certainly not.
But can't we use this in some respect to at least get a better understanding of what are unsafe and unsound banking practices and violations of law and or regulations? Because the order outlines all of these things as unsafe and unsound practices and violations of law and regulations.
Isn't it really like a NOLO plea?
Well, it outlines all of these things, many of which are included here in these loans. You don't agree that you did those things, but didn't you agree that they are unsafe, unsound, and lending practices in violation of laws and regulations?
I'll try and answer it directly by pointing to the particular example that's most relevant here.
Okay.
One of the criticisms, one of the I say findings, although there's no adjudicatory finding, of course, in the FDIC order, is that Fremont didn't underwrite the loans at the fully indexed rate.
Right.
And that what they did was use the introductory rate.
Correct.
Absent from that March 2000 cease and desist order is any suggestion of any source of authority, any practice by anyone else in the industry, or anything else that would say that that violated an established concept of unfairness. That came later, and the FDIC, which is their job, reacts to the changing environment and changes the rules over time as to how it is banks are supposed to behave.
What was the date of that consent order?
March 2007, after which Fremont made no loans.
Thank you.
Thank you, Mr. Carroll.
Thank you, Your Honor.
Mr. Barry-Smith?
Good morning, Your Honors. My name is Chris Barry-Smith, Assistant Attorney General. It is incorrect to say that either the Superior Court's analysis or the Commonwealth's case relies on hindsight. These loans are predatory and unfair, and they were unfair and predatory when they were made.
Whose definition of predatory? We have a predatory statute that actually does. Are these within the predatory statute?
When I use the term predatory and unfair, I refer to the bedrock principle of banking that it is unfair to make a loan that the borrower cannot afford to pay.
So that's how you're defining predatory, as a loan that the borrower cannot reasonably repay is predatory.
I would say unfair and predatory, because unfair is the critical term under 93A. That principle is an established principle of unfairness that goes back to at least 1992.
All right, you're using predatory as a very derogative term here. And have they been accused of predatory lending practices? Did the judge find below that they've been involved in
No.
predatory lending practices?
No, this case involves unfair
Correct.
lending practices.
All right.
You don't, that's just surplusage. You don't need to use the word predatory.
That is correct, but there's a reason I do use the term, and that's because since 1992, both the Division of Banks, the OCC, and the FDIC have described both types of lending together, predatory and unfair. When you make a loan that a borrower cannot afford to pay, that is unfair and that is predatory. The reason
Aren't these loans specifically referred to in the 1997 warning from the commissioner?
They are, Your Honor, in that
Well, it's,
He specifically says if you're engaging in unusually high debt-to-income ratio of borrowers' loans, and that's what we have here, do we not?
yes.
And he further says if you're engaging in subprime loans, we're going to keep a real eye on you because this may be unfair lending.
That's correct, and for that
So this
1997,
has been out there since 1997.
that's correct, and it's not just from the Division of Banks, but dating to
but
1992.
did the Attorney General ever adopt a regulation declaring the practices here invalid, knowing that there was this 97 directive from the Banking Commissioner?
The Attorney General had regulations on mortgage lending, but they were a narrow type of home equity loan,
Right.
not these loans,
But the Attorney
until
General
2008.
has many, 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 many regulations under 93A, but didn't adopt one here that didn't adopt one that would make the practices here invalid until, what did you say?
They were effective January 2008. But
They just have been adopted.
93A provides that we can attack unfair conduct either retrospectively through litigation or prospectively through regulation. We've done both. We have filed lawsuits, including the one against Fremont, that indeed go back in time to 2004 and say when these loans were made, they were unfair. The reason is not just because 183C is a concept of unfairness found in Massachusetts law, but because for 17 years, the concept that you cannot make a loan a borrower can't afford to pay has been well established. No lender can claim surprise that that is a principle of fairness in lending. I think the best argument Fremont can put forward is that there is that principle in lending, but the details of how to apply that principle to specific loan products were not detailed until 2005 through 2008. That is immaterial because the only way that argument can succeed is if it passes the 93A Section 3 threshold. 93A is flexible, but it does have its bounds. The two principal bounds are either preemption, not at issue here, certain matters can be taken out of the field of 93A, or Section 3. Fremont has to point to a regulation or statute that affirmatively permits this type of conduct. There's no statute, regulation, or even guidance that says you can make loans that borrowers can't afford to pay, nor is there the more specific statute, regulation, or guidance that collects these risk factors that the judge relied upon and says that they are permissible.
Where did the judge get those four factors?
The judge got those four factors from the evidence in the record.
But those four factors were never established by any court or by any directive or by any regulation.
The collection of those four factors
Correct, altogether.
is found in no particular regulation or guidance, but that points to the scope of 93A.
Finish.
93A specifically goes beyond, based on all the facts and
and I think
circumstances,
that-
a particular regulation or statute that might exist, including 183C or anything the federal government has done.
Mr. Barry-Smith, it would be helpful if you could sort of help me through this. This is a highly regulated industry, correct?
Yes, in that there are at least 4 different state and federal regulators that touch
Yeah,
mortgage
I mean,
lending.
there's some conduct out there, you know, I take my car to the local, you know, repair shop, and that's not regulated to any real degree. This is a highly regulated industry. One of the claims that is made here is that even assuming that there's some, you know, 93A extends out beyond a regulation or statute, if lenders don't know where that is, that has a powerful impact on whether lenders will operate in Massachusetts.
Correct. The notion that
That it's somewhere, I mean, you say it's bound, but that it's somewhere beyond what regulates this highly regulated industry, and then it's someplace beyond that, but nobody knows how far beyond it is.
Right, but I think there is an argument that creditors would decline to operate in Massachusetts if those judicial determinations of unfairness without a specific regulation or statute were a surprise or unpredictable. This is not that case, because the essential principle relied upon by the Superior Court, as stated before, is you can't make loans that borrowers can't afford to pay.
These are 100% financing loans, are they not?
Yes, and that's a
I mean,
critical factor.
You did a statistical study on 98 or 100 of these loans, as I understand it, and you found the majority of them were 100% financing, when the usual conservative basis is much less than that. You found many of them had additional prepayment penalties, did you not?
Correct.
And all of the loans that you examined were in foreclosure.
Right. That loan sample that you point to were the only ones available to the Commonwealth at the point of the
From which a
preliminary
reasonable
injunction.
person could draw the inference that any reasonable banker would not write these loans,
And I would,
because they're doomed to failure.
that's what the trial court found, and I would point out that the trial court was much more exacting in that analysis than we think the court had to be. We suggested that failure to take into consideration in some manner whether a borrower could afford the loan after 2 years by itself was enough to satisfy the
You may not know this
principle.
question, but how did they get to 100% financing? Were they using appraisals? And who were doing these appraisals? Do you know?
Consistent with industry standard, there were appraisals done on every loan and typically in 100%
Have these
loan.
appraisals been examined? Or is that not part of this
It's not a
lawsuit?
central part of this case. Your Honor may be familiar with other lending cases that really focus on appraisal fraud. That is not central to this case. I can't say
This
whether
is
or
just
not.
sort of a
Is it
background.
in this case at all, or it's not central to this case?
It certainly was not before the court on preliminary injunction.
So it's not in this case?
After discovery at trial, I anticipate
not
that there.
before us, though.
It is not before us. I
Okay,
just don't want
Sort of
to.
as a background question, loans that are 100% with a 100% loans like these, there's a great chance that the borrower can't afford to repay, as has happened here. And statistically, you've shown that. Then what is the commercial benefit to the lender? Because they can resell a loan to somebody else who doesn't care whether the borrower can repay. Is that?
In
Is that-
the traditional.
Because who would make a loan to somebody who can't afford to repay? They don't want to be in the real estate business.
I think your question points to what has occurred in the industry over the last decade, and that is that typically 100% loans would make little sense to a conventional lender that kept the
Right.
loan in their portfolio because they had no cushion to guard against the risk of non-payment.
Right.
What has happened.
Particularly if the market goes down, the real estate market, then they're
Correct.
stuck.
We contend, in our complaint at least, it's also not before the court on preliminary injunction, that one of the reasons these admittedly now unsound loans were made was because Fremont did not have to live with the paper. Fremont's not unique in that regard. They made the loans, and they were passed on to be resold and securitized. And one of the essential problems commentary has pointed out into the subprime mess that we are now experiencing is that because no one that made the loans had to live with the responsibilities of the bad paper, that the underwriting standards essentially ceased to exist. Fremont is an example of exactly that aspect of the subprime crisis, but I don't mean to nor need to rely on the overarching subprime crisis. The reason the preliminary injunction was entered in this case was because of what Justice Graney referred to. We showed that of the loans that lead to foreclosure, there was always a prevalence of these risk factors layered one upon the other. As I mentioned, we thought the court could have stopped
Right.
after failing to appraise ability to pay beyond 2 years, because that itself was
Can
unfair.
I ask you this question, though? You mentioned this when Justice Graney asked the question, or perhaps it was in his question. You examined 98 cases. They were all foreclosure cases.
That's correct.
Right, so
By
you didn't examine
definition.
1,000 cases, of which 98 were foreclosure, and the others were successful loans that were refinanced. You just looked at the foreclosure cases.
Right. And
98 out of 15,000?
because that's all we had before us, and because the only relief we were seeking with respect to the preliminary injunction was an opportunity to be heard before foreclosure. So I would suggest that it is certainly a self-selecting sample. That's all we had. But it's all that we sought to touch by the preliminary injunction.
But then what do your numbers show? They don't show anything. If you took 98 loans on which there have been foreclosures, then of course they've all been bad loans.
Well, they all...
You're not showing what percent
They
of the
showed
total.
characteristics, is what you're saying.
Our unfairness case, as opposed to a very fact-specific deceptiveness case, turned on the following theory, that by their very nature, that these loan products, with the risk layers identified by the judge, were not just bad luck that ended up in failure, but it was predictable and certain at the time the loans were made that the borrower could not afford it beyond 2 years. And
How, of those 98, but if the total number of loans made was 98,000 and only 98 were in foreclosure, then it wouldn't mean very much. It would mean that most of the loans were predictably good.
And if I could answer that by referring to Justice Cordy's earlier question, there was a total, there's no dispute, and it is in the record, that there's 15,300 plus loans made by Fremont over the course of 3+ years. Of those, at the time of the injunction, 2,900 remained alive. Some ended in foreclosure, but the vast majority were in fact refinanced. One of the issues in this business model is the serial refinancing, but that's beside the point.
It's not beside the point.
It's not beside the point because it's part of the predatory conduct at issue.
It's
These
also
loans,
part of rational conduct. I mean, if I can only afford that lower introductory rate, but I think I'm going to improve and I'd like to buy this house, I, of course, am planning to refinance at the end of the introductory rate. That's part of my strategy. That's part of a rational strategy by a buyer.
it could be,
Yeah,
but
well-
there remains a responsibility on behalf of the lenders to, in some manner, gauge ability to pay.
But you're not claiming that Fremont, or are you claiming that Fremont is responsible for the fact that when they enabled somebody to get into the real estate market and then it was refinanced, that Fremont is responsible because the refinancier engaged in, quote, unfair practices?
No, those, with respect to the remedies that we sought to restrict in some manner foreclosures before they happen, it only concerns loans still held or serviced by Fremont, so that those that have been refinanced are not part of this preliminary injunction in any manner.
Did your investigation, did you look into at all whether credit counseling was given to the people that got these loans, as the Commissioner of Banks seemed to want and direct back in 1997? Or is that something you're going to look into later, along with the possibility of fraudulent appraisals?
I can say the information we have before the preliminary injunction, I would suggest, was anecdotal or example affidavits from 8 consumers.
I assume all said
and none
they
of them
got any
experienced credit counseling.
at all, and
So
we're not told
our
that, look,
expectation-
you folks aren't going to be able to pay this loan.
Right.
Were all 15,000 of these loans made to people, or were
Subprime.
to these subprime loans, were they all made, or was a substantial portion of them made to people who were, limited credit or poor credit risk?
Generally speaking, yes, the entire portfolio was subprime, but that term generally refers to the creditworthiness of consumers.
Yeah.
Right.
But
That's all 15,000 loans.
generally speaking, yes, but our case for unfair loan products, aside from deception, will not reach 15,000. We can't say with precision where it will reach, but even if you just rely upon the very exacting factors that the Superior Court found to be inherently likely to lead to foreclosure and failure of the loan, there will be, the court found at page 8, a significant number of loans that satisfy that criteria. To be frank, we will attempt at trial to expand the concept of unfairness to include other risk factors, but that remains to be seen. It won't be 15,000 loans that by their very terms violate 93A, but it will be a meaningful chunk.
Mr. Barry-Smith, let me ask you this, and I just need the facts. Do you know of the 98 foreclosures, how many, these are all foreclosures on homes that where title has passed to the homeowner, correct? I mean, the homeowner is sitting with the title.
Yes, and
Okay. Do you know how many of those loans were people who had held title to their homes before this financing was in place, as opposed to new homeowners coming into the market?
not with precision as to those 98, but there's an affidavit from a Fremont employee, Laura Calms, that describes the portion of its loans that were refinances as opposed to purchase money. It is the vast majority. I think it's in the high 80s, but I'd be happy to follow up with that
Thank you.
specific answer.
And I take it that in addition to losing a home, right, what the impact of foreclosure is that, because one could at least theoretically argue, if you couldn't afford a home in the first instance, that's unfortunate, but you lose your home. But I take it that what's really at issue here is that those homeowners now will owe substantial amounts of money, because I assume that they will be on the hook for the difference between whatever the face amount of the loan is and whatever the home, when it is sold.
The deficiency.
Yeah, technically, there is an opportunity, especially at 100% financing with a decreased real estate valuation, to pursue a deficiency judgment. I don't want to suggest that's part of this case. Generally speaking, in the current climate, lenders are not seeking deficiency judgments following foreclosure, and I have no evidence whether Fremont does or does not, but it's not central to the Commonwealth's case.
So what's at issue here is, from the borrower's point of view, is loss of home.
It's loss of home without an opportunity to be heard, whether or not there may be loan origination claims based on unfairness or deception. That's what the Commonwealth sought here, was an opportunity to be heard before the ultimate relief of foreclosure was achieved vis-a-vis any borrower. In
You
the
said
absence-
you said the homeowner.
Yeah.
Now you're saying you want an opportunity to be heard. The homeowner would have an opportunity to be heard, presumably in a foreclosure proceeding.
The homeowner doesn't have an opportunity to be heard in a non-judicial foreclosure state like
Okay,
Massachusetts.
I'm a defrauded homeowner. What can I do?
Conceivably, you could file an affirmative action in Superior Court, but the foreclosure process itself does not provide an opportunity to raise these defenses.
Well,
But
you
make
say-
no mistake, we
you
do
say
intend to do that
conceivably.
on their behalf.
Conceivably is impossible. These people don't have money to hire lawyers to file their own 93A claims or anything like that. They have no remedy but you,
I would
practically speaking, because the foreclosure is an automatic procedure where you dot I's and cross T's in the land court.
That is exactly correct. Absent this preliminary injunction and absent the Commonwealth's attempt to at least be heard prior to a foreclosure, Fremont will be able to foreclose without consideration of whatever the Commonwealth may be able to prove that was unfair or deceptive
Do you
at the loan
contend
origination.
that all 15,000 of these loans were unfair?
No.
Do you know what the percent? Now, this looks like about
The
one
answer
out
to
of.
that is no.
All 15,000? The answer is no, because a loan becomes unfair, in our view, when it fails to comply with the established standard that you have to assess a borrower's ability to pay.
But then you're looking at it from hindsight. If either they're all unfair from the beginning or they're not, because either the bank is applying the concepts that you have to apply. Either they're giving them these credit counselors and they're determining the ability to repay under the entire length of the loan or just the beginning rate. I mean, I don't understand that.
I'm giving you a misimpression because it's so different than the facts that were pursued at preliminary injunction. Fremont made some loans that were 80% or 70% LTV and some loans that were fixed rate. Those do not pose, it's a small portion,
So they
but
made
those
some-
types of loans don't pose payment shock or predictable unaffordability likely to lead to foreclosure. And then the judge said, oh, there is still a safety valve, and that is the potential to refinance. And that's why his fourth factor of 100% LTV or significant prepayment penalties, it's the combination of the four risk factors identified that predictably lead to a loan that will fail.
But how was the bank supposed to know, back whenever it was, that those four factors in combination are unfair when you told me before that though they had never been put together before by any authority or case or directive?
Because the bank had clear directives for 17 years that you had to you could not make loans that a borrower couldn't afford to pay.
I know you said this, but where is that 1992? Where was the directive in 92?
It's at 1469 and 1709 of the joint appendix for the federal versions, and then it's at the addendum.
Would you say that again slowly?
Joint appendix 1469 is a 2001 guidance that highlights the 2 points that I've referenced, and the OCC's version from 2003 is at 1709.
So where does 1992 come into this? Because you said since 1992, it's been known that the banking standard is you shouldn't be loaning to anybody who,
Right.
doesn't have the ability to pay.
I referred to the two pre-2004 statements of unfairness that I've been relying on that are most on point, but the earliest one is federal interagency guidance dating to 1992, which can be found at 1435 of the Joint Appendix.
Thank you, Mr.
Well,
Barry
I
Smith.
just have one other question. The percentage here, if it's meaningful at all, is about 1 out of 1,500 mortgages went to foreclosure. How does that compare to the conventional mortgage foreclosure rate, if you know?
That piece of information, I think, does not translate to Fremont's overall portfolio, because the only loans we had were 98 that were proposed for foreclosure.
Now, I'm
It
talking
didn't
about the
take
market
into account.
generally.
Right.
What is the foreclosure rate, if you know, in the market generally for conventional mortgages?
I don't know the foreclosure rate, although I'd be happy to follow up with the latest information.
As
I
long
know
as you're covering the same time period.
Excuse me?
As long as you are covering the same time period. So you don't give us apples and oranges. Don't give me a thing that says from 1994 to 2008, because you're going to include in that very
Right.
robust, it's whatever the time period is that you're covering here.
Right, and I was just, see if I could finish the response. I don't have precise foreclosure information specific to Fremont. I only have severe delinquency information, which is a proxy for anticipated future foreclosure. And the record shows that at the time of the preliminary injunction, 20% of Fremont's overall portfolio was in severe delinquency, and we would suggest on its way to foreclosure. In the interim 8 months, for the industry, that figure has increased substantially, and public reports show that of the subprime portfolios, generally speaking, the severe delinquency rate is up over 35%. I don't know what Fremont's would look like now. I only know what the record showed at the preliminary injunction phase.
Thank you,
You're not
Mr.
suggesting that subprime lending is unfair?
As
Because subprime lending is lending to people who, on most underwriting standards, would not be able to afford a mortgage.
Absolutely not. In
That's the whole
fact, the
point.
government in several ways has encouraged subprime lending, but not subprime lending that fails to account for a borrower's ability to pay.
Thank you, Mr. Barry Smith. We'll take a short break.